Hey, welcome to the Explainer. Today, we're going to tackle something in the stock market that, well, it looks like a crazy complex code, right? But what if I told you it's actually pretty simple once you have the key? Let's crack it open.
Okay, but before we dive in, we have to get the important stuff out of the way. This explainer is for learning purposes only. Options trading involves very real, very significant risks, so it's absolutely crucial to understand those dangers before ever even considering a trade.
All right, so have you ever been staring at a trading screen and you see this string of letters and numbers, and it just looks like a secret message? It's so easy to get bogged down, but I promise you, it is not as intimidating as it looks.
Yeah, this is the code we're going to crack today. And stick with me, because by the end of this short explainer, you'll be able to look at this and know exactly what every single piece of it means. Let's get to it.
Now, to understand that code, we're actually not going to start with the stock market at all. We're going to start with something much simpler, a land deal. Seriously, think of this little story as our Rosetta Stone. It's the key that's going to translate everything for us. Okay, so picture this. In our story, you found the perfect piece of land. You want to buy it. That land, that's the whole reason for the deal, right? It's the main asset. In the world of options, we call this the underlying. Simple enough. It's just the thing the contract is all about.
All right, so you and the seller, you agree on a price for that land. Let's say 50 lakh rupees. Now, this price is locked in. It's fixed. I mean, it doesn't matter if they announce a new highway right next door and the land's value suddenly doubles. Your price is set in stone. This pre-agreed price, that's what we call the strike price.
Now, this deal isn't going to last forever, right? The seller gives you a deadline, let's say 6 months, to make up your mind. You have the right to buy that land for 50 lakh any time in those 6 months. But here's the key part. You're not forced to, you're not obligated. That deadline is the expiry.
So, to lock in this awesome deal, this right to buy, you pay the seller a little something upfront, a non-refundable token amount, say 5 lakh rupees. Think of it as the fee for holding your spot, for locking in that price. This upfront cost is called the premium. It's the price you pay for the right itself. Okay, you with me? You've got the land deal down pat. Underlying, strike price, expiry, and premium. Now get ready for the aha moment. Let's take what we just learned and translate it directly to the stock market. Let's crack that code.
And this is where it all just clicks into place. Look at this. The piece of land, that's our SBIN stock. The 50 lakh price we talked about, that becomes the 460 rupee strike price. That 6-month deadline, that's our October expiry. See? It's the exact same structure. And that little CE at the end, that just tells us it's a call option, which means it's the right to buy.
Pretty cool, right? Feeling confident? I bet you are. Let's put it to the test. The pattern is always the same, so let's try decoding another one just to be sure.
All right, here's a new one for you. Tata Motors October 340 CE. Now, before I just give you the answer, take a quick second, see if you can pick out the parts yourself. What's the underlying asset? What's the expiry? What's the strike price?
And time's up. If you broke it down like this, you absolutely nailed it. The underlying is Tata Motors stock, of course. The expiry is the last Thursday of October. That's just a market rule. The strike price is 340 rupees. And in this case, the premium, the cost of the option, is 19 rupees and 25 paisa. It's just a repeatable formula.
Okay, we are so close. We're almost there. But there's one last really important detail where our land analogy and the stock market are a little different. It all comes down to scale.
You see, in our land deal, we were talking about one transaction for one piece of land. But with stock options, you don't buy the right to just one single share. It doesn't work that way. You buy them in standardized bundles or sets, and these are called lot sizes.
So, going back to our first example, the State Bank of India option. The lot size for that contract is 1,500 shares.
So what does that mean for your wallet? Well, to find out your actual total cost to buy the option, you use a really simple formula. You just take the lot size and multiply it by the premium.
Which brings us to our final answer. You take that lot size of 1,500, you multiply it by that premium we saw earlier, which was around 1,750,
and that comes out to about 26,000 rupees. That's the real amount of cash you would need to own this specific right to buy.
So there you have it. You've cracked the code. You know what all those terms mean. You even know how to calculate the real cost. But, as you've probably guessed, this isn't the end of the story, not even close. In fact, this is really just the beginning of the journey.
Because think about it. Once you click buy and that order goes through and you actually own that call option on SBIN, now what? What happens next? What does owning that contract actually let you do? And this opens up a whole new set of really critical questions you have to ask yourself.
As a buyer, you have to know the answers to these questions. What is my total risk? I mean, what's the absolute worst-case scenario? How much money could I lose? At what price does the stock need to be for me to just break even on this trade? And if things go my way, what's my maximum profit potential? Is there a limit? We'll tackle all of those questions next time on The Explainer.